if we get inflation that's running hot in the super hot US economy, particularly with expectations that tariffs are more inflationary, well, that can drive expectations that the Fed won't need to cut rates and can push the US dollar higher as well.
This is Converge, a podcast from Convera. Come with us as we shape the future of finance.
Welcome back. It is January 29th, nearing the end of the month. I have Stephen Dooley, Head of Market Insights at Convera, back with me today to break things down. Steve, good to have you. Obviously, this has been a interesting start to the year, not unforeseen, certainly interesting, playing out as one might have expected. You and the team are just finishing up a review of markets with the February global FX outlook. And I imagine that Trump, uncertainty, and unpredictability will be front and center in this report. Am I right?
Well, thanks for having me on, Alex. And you're absolutely right. Look, this month there's no prize for guessing that it's the inauguration of US President Donald Trump that's the dominant event in financial markets over January. Really, it's been the dominant theme ever since the election win in November. Global equity markets have climbed steadily since Trump's November win. And the US dollar has really been driving FX markets higher. The US dollar index, for example, has gained more than 6% since the US presidential election. And it's really both those markets have been driven by the same factors. It's expectations of growth-focused policies from Trump. And really that inauguration was the key moment when the new Trump administration wasted no time with a series of executive orders enacted on day one on a whole range of different fronts. But of course, what we're really looking at is those growth-focused policies for the global and US in particular economy. But what was interesting, and again, this is the theme from Trump's first term, I suspect it's going to be the theme in Trump's second term as well, is that Trump was actually less aggressive initially in announcing new tariffs. And in FX markets, it's these expectations on tariffs on Canada, tariffs on Mexico, tariffs on China that have really been driving the currency markets. And we've seen the Mexican peso, the Canadian dollar, and the Chinese yuan, the currencies that have been hit the hardest. But Trump was actually less aggressive in announcing new tariffs on day one. Instead, he only announced a study into destructive trade policies and currency manipulation. So as a result, at least in FX markets, the initial impact wasn't as negative for those currencies as perhaps we initially had expected or markets had initially expected. The US dollar eased on the news, much like we saw when Trump came into power in January 2017, and trade-focused FX like the Aussie and the Euro are rebounded. So, but again, just to really illustrate how, sometimes they say history doesn't repeat, but boy, does it rhyme. Just a couple of hours later, Trump revisited those tariff threats, and we saw the US dollar jump higher, those trade-focused currencies weaken, and it just really illustrates that potential volatility and unpredictability that we might need to get used to in the Trump 2.0 era.
Yeah. Do you want to touch a little bit more on how it played out? I mean, you mentioned high-level FX impacts in the markets. Can you touch on how it played out in the FX markets in a little more detail, both in the US and more broadly overseas?
Yeah, look, I think really need to think about this dominant trend in FX markets since October. It was quite incredible that first day of October, there was a change in the market pricing over who markets thought was going to win. It really shifted from Harris to Trump, and we saw the US dollar pick up steam there. We saw equity markets gain there. So there's been almost this uninterrupted run of US dollar strength from the 1st of October up until towards the end of January. So, the US dollar had surged over that 3.5 months. But after the inauguration, we actually saw a pullback from those 2-year highs in the US dollar. The US dollar index actually fell 2.9% from the recent highs. And that's the biggest pullback we've seen in the US dollar since September. So they say sometimes in financial markets that you buy the rumor and you sell the fact. That's really come to play this time. Financial markets bought the US dollar in anticipation of Trump's win, in anticipation of Trump coming to power. But almost the second that Trump did come to power, that US dollar started to fall. So buying ahead of the event and then falling afterwards. In other FX markets, it was the reverse. So the euro's seen very sharp losses. It was actually one of the hardest hit currencies post that move that we saw from the start of October. But it actually had a huge rebound over the last week or so after the inauguration. The euro-US dollar recorded its biggest weekly rise. It was up 2.1%. That was the biggest weekly rise in a year. Traded above 105, the euro-US dollar, for the first time in 6 months. So a big, sharp reversal in markets after day one for Trump. The British pound, similar, suffered a monster meltdown since October, down more than 8% versus the US dollar. But again, the British pound US dollar pair rallied sharply from those 2-year lows at the end of the month, in line with most other markets. I guess the one currency that didn't really see much of a rebound was the Aussie dollar. That's been dead last really in the G10 currency ranking since October. It's not just tariff worries hitting the Aussie dollar, it's worries about China's slowdown, and the Reserve Bank of Australia looks likely to start cutting rates. So as a result, the Aussie dollar's had a horror run, and it actually fell back to 2020 lows by the end of January.
My oh my, that's some monstrous activity out there in the currency landscape. Let's turn over to the more, I guess, growth facing economic outlook. If we were going to talk about the United States first in particular, obviously the past 2 years have been a lot of doom and gloom narrative with regards to a recession impending. What are the U.S. growth prospects looking like now, given all of this shaking up from Trump and, the rate environment, the rate cut or lack thereof environment? What's the growth outlook that you can foresee in the short and medium to long term?
Yeah, I mean, that's a great point, Alex, because for the last 2 months, economists and market analysts had consistently warned of an impending US recession. But the US actually defied all those expectations. It was the best performing developed economy over the last 3 years. I think Spain in 2023 might have outperformed the US. But apart from that, the US is just absolutely dominated, partly driven by the large spending programs from Biden, but also the big impact of AI and the AI boom in the US economy as well. So as a result, the US economy, I should say, has just kept on keeping on. But like I said, the red lights had been flashing. We'd seen yield curve inversions, which had previously had 100% accuracy in forecasting recessions. That didn't come to pass. The rate hikes that we saw from the Fed in 2022 and 2023, they didn't particularly impact tightening credit conditions, but the US economies just kept on keeping on. And as we go into 2025, prospects still look good for the US. I mean, the labour market's still really strong. Consumer confidence had a big pickup consumer confidence and business confidence post the Trump win has had a big pickup. Corporate profits still remain strong. So again, while we still do have some of these flashing red lights in terms of warning of a US slowdown, they have really diminished in terms of their impact. And for now, at least for the next 6 months or so, the US looks like it can keep on keeping on.
Yeah, not even the big DeepSeek AI scare could seem to take it down in terms of the momentum going on with the AI growth and in that realm of our economy and future outlook. That certainly was something of note this past week. What about Europe? Can we talk about Europe and its prospects? I mean, really, can it get much worse than it's been going?
I mean, that feels like that we've reached a bottom in terms of negativity around Europe. And of course, the euro US dollar pair, which is an important benchmark in terms of the global sentiment around the market, fell back down towards that 102 level, levels that we haven't seen on the euro US dollar since 2022. That negativity really had, I think, reached an nadir over the last couple of months. We haven't just got worries about growth, worries about tariffs. We've got political gridlock in France and in Germany. Worries about a slowdown in China is particularly negative for Europe, but it has really built up to a point where much of this pessimism is now really already reflected in asset prices. And I think we've seen this in the euro over the last couple of weeks. We mentioned earlier it had its best 1 week performance in a year. It jumped from 102 up to 105. That's telling us that maybe we've reached that point of maximum negativity on the euro. So probably setting myself up for a fall here, but we're almost at the point now where it feels like things can only get better for Europe.
Okay.
So if we do see even a small increase or improvement in economic data, that could trigger a strong market reaction this year. So that's what we will be watching for this year, is whether things have reached sort of that point of maximum negativity in Europe.
Yeah, great. How about in FX markets? Obviously, we know it's central banks that and their reactions to inflationary pressures that tend to drive the moves in the market. What is the outlook as we head into February in terms of how central banks are reacting to these pressures that are ongoing? And what do you foresee the next few months looking like?
Yeah, well, I mean, in FX markets, in terms of driving market moves, what tends to be the biggest mover from central banks is if we get divergence, if we get central banks moving in different directions. And we saw that over the course of the week. Bank of Canada, for example, cut interest rates by 25 basis points down to 3%. They've cut interest rates from 5% in the middle of last year to 3% this week. So they've really been cutting quickly in Canada. On the other hand, this week we saw the Federal Reserve hold interest rates. They've cut rates on 3 occasions in the back half of 2024. But this week they decided just to pause for a while, wait to see how inflation's playing out. It's a bit hotter in the US than it is in other parts of the world. So this is where we're starting to see these bigger moves in markets. And for example, the dollar CAD, highest level in 5 years, up back at that 145 level. Just before that move that we talked about in October, dollar CAD was around 135. So we've moved 10 big figures in little over 3 months. So it's been a historic move in the dollar CAD. And again, it's that difference in interest rates that's having a big impact. Of course, those tariffs are also having an impact as well. But it just really goes to show how massive these moves can be when we start to get divergence between central banks. And that move from the Federal Reserve to hold rates steady really does signal that there is the potential for the US dollar, which I mentioned earlier, has just pulled back from 2-year highs. It really can continue to power higher if the Fed does hold rates steady and we do see further moves from other central banks. So also this week, there's a widely expected outcome with the euro. The European Central Bank is expected to continue to cut rates. This week in Australia, a much lower than expected inflation number means that the Australian Central Bank, the Reserve Bank of Australia, is more likely to cut rates. That's pushed the Aussie dollar again back towards 5-year lows. So we're seeing big moves in currency markets. Like I said, dollar CAD at a 5-year high, Aussie dollar at a 5-year low, the US dollar powering higher, and a lot of it comes down to these that divergence in central banks. So that's what we're going to be watching for this month, Alex. If we get data, inflation data in particular, from Canada, from Australia, from the Eurozone, that shows that inflation's coming down more quickly, more rate cuts, more weakness for those currencies. On the other hand, if we get inflation that's running hot in the super hot US economy, particularly with expectations that tariffs are more inflationary, well, that can drive expectations that the Fed won't need to cut rates and can push the US dollar higher as well. So we've already started off with some big moves in January. It's not just about Trump. It's about divergence in monetary policy. And the next few weeks of inflation data will really tell us if we can expect to see more big moves as we continue through the first quarter of this year.
Love it. Well, you always bring the energy and enthusiasm for what's to come, Steve, even though we are bathing in uncertainty as always, and there's lots to look out for in this era of move fast and break things, Trump 2.0. But we'll have you back to analyze whatever we can in the next couple of weeks. Steve, thanks again for being here.
Thanks for having me on. Love to be part of the program. Thanks, Alex.
Always great to have you.